Now, I'll be very honest with you, and I think I just touched on it when you were speaking. So Steve and I, just for the record, could not be more different when it comes to our investment literacy or just our general approach or thoughts about the topic. So you pose kind of a good question. I think the space that you're in is kind of super nascent, especially for the region.
Right.
Why do Arabs, generally Arabs, especially that are from here and grew up here, why is our parents' generation or even our generation so kind of hesitant to get into investing? Is it cultural? What do you think the reason is?
Yeah, I definitely think it's cultural as opposed to a trend between developed or developing or emerging countries, because in the UAE we're exposed to so many nationalities, and the most mature ones we see isn't even Canada or US or UK. It's actually India. So while India is considered as a fast emerging country, and culturally they're just so advanced on the importance of saving, on coming up with a SIP, a systematic investment plan, versus as Arabs, the traditional advice is quite terrible. It's a lot of حبيبي حط المصريات تحت التخت, like to be
your mattress.
Sorry. So it's a very conservative approach to it's a lot about saving. We barely there's spending, saving, and investing. It's still there in managing your spending, or and hopefully saving, as opposed to once you understand investing, you realize it's not really, once you get the implications of investing and how beneficial it could be, and how you can manage your emotions, you're like, this is not optional. This should have been like, you ask older people what are one of your regrets about money, they'll tell you, I wish I started sooner. That's number one.
But it's crazy. Like, if you look at more developing markets, people kind of, their perception of the difference between people who invest and people who don't invest, it's kind of like a societal hierarchical thing, right? It's like the higher up you are on kind of the wealth ladder, the more kind of appetite for risk you have, and the poor man will always tell you, the harder you work, the more you'll have in your savings, so earn more and you'll be fine, right? It's a very kind of bottom of the pyramid kind of approach, especially when I was in Canada as well, and that was kind of the perspective. The higher up you were on the ladder of life, the higher the propensity, or risk kind of appetite, you had. Now, the Middle East, I mean, obviously has such a huge wealth disparity between kind of, how it's dispersed, right? So there's a very small group of ultra wealthy at the top, and then there's a very big population that are living, just above the poverty line or below. I think the UAE is kind of, it's in its own breed. It's a bit different. It's a bit different than the rest of the Middle East. But generally, when you look at the Middle East, now, would you say that that's also why? Is it because we're risk averse, because most of us don't have that much cash? We don't have the kind of mind space or the liberty to even think about that? Like, is your savings and your earning capacity kind of related to your ability to invest? Is that fair?
It depends. I would break it down into a few things. Like, for one, it's an evolution. I think we're newer at. You're right. The UAE is very unique, where you have, like you said, a lot of Emiratis that are super wealthy with super nice cars. But God knows if investing is on their radar.
True.
To isolate as an example, that's, I guess, we see every day. What I'd like to highlight is the role, for example, that governments can play. So, for example, in Canada, you'll hear about a tax-free saving account. In the US, you have the 401k. So I feel like it's a lot of your environment. As Arabs, what I've seen is we really like real estate as something that is very tangible. And like the most popular ones, I would say, are cash, real estate, maybe gold. But in general, as we were brought up, we weren't really taught on how to save, how to invest. We're not diversification, mutual funds, and investing. A lot of these concepts aren't taught at school, even in the developed world, right? But here, I think it's even more visible, where It's not part of the curriculum, so you're not really taught on how to do it. So you rely on other sources such as, government or family and friends to influence you.
Yeah, absolutely. And I think when I look at my father growing up, I think the only thing he really put money into was property, right?
Right.
That was really the only thing.
It's
And
like bricks and mortar, right? That
yeah,
was a safe bet.
and to be honest, like poor guy, like I think he invested at the worst possible time. Like in Canada in the '90s, you'd buy a property and the value of that property would hardly move. And then come mid to late 2000s, and the market just goes crazy and does amazing well. But at that time, those markets were very different. Now,
Yeah, and just to touch on property in general, like we'll get into different asset classes, but it's, in our portfolio, we do have a certain part in properties, and we like
yeah,
real estate as an asset class. We're just not a big fan of putting your money in one or even
yeah.
multiple buildings because most likely they're going to be in the same
The
country.
concentration of risk is in the same sector, in the same area.
Correct. So you're concentrating a lot of your risk, and it's a lot like starting a business or investing in a business,
Yeah,
where you can get lucky and you have to do certain people are really good at it, but the average person in general, it's just you don't need to go that extreme to make significant returns.
yeah. And what are you seeing so far? So you said you have 10,000 users, and how are you kind of measuring the investment style of the region versus other areas? I mean, you have, I'm sure diverse portfolio and in terms of caliber of clients, I'm sure, but generally, what are your outlying kind of takeaways? Like what have you learned from the way people invest so far?
Yeah, it's a great question. I would say so. One way we approach it is we give users feedback on where they are on the spectrum of investing. So we have simple, beginner, intermediate, expert, and we sort of define what each of these are. So you'll have certain trends such as some nationalities anchoring more towards expert, intermediate, but more important from a behavior perspective, beginner is someone that just got started, which is a huge win. Like someone that got started with investing it's still a big moment, even if it's our minimum, which is $500. So because the sooner you start, the better. $500 doesn't sound like a lot, but a lot of the time, if you go on the website, one thing we like to show is $500 now could be in 30 years that amount of money is going to be significant. When you put $1,000, 30 years compounding, you're suddenly talking about $200,000. You're like, wow, that's a full year of an amazing salary. So
it does depend on inflation.
So intermediate, I guess we'll start to discuss more the impact of inflation and should you be investing one shot versus should you be investing in multiple multiple months. You start to see systematic deposits and also referral. People are more comfortable to talk about in investing. And the expert, I would say, what we see is, all right, I know I need to invest. I know what to invest in. I'm comfortable with the market volatility. I'm not going to try to time it. But now tell me, let's talk about financial planning. This is where it gets super interesting. Where it's like, okay, if I want to retire in my 40s, what do I need to be doing? If I need to retire in my 30s, again, super ambitious goal. But or if I want to pay for that mortgage and be almost guaranteed that, or guaranteed that I want to be able to take out that down payment or buy that house. So goal-based planning is, I think, the most exciting part and the part that makes it real for people to understand that by investing, the difference between it could be the difference between retiring at 65 or 50 if you do it right.
Yeah, and this is one of the big things, right? The education around money and what to do with it. I mean, Chris, you were talking earlier, like keeping your money in the bank from a cash perspective. If you just save, technically over time that value is decreasing and decreasing, right? But there's not necessarily the platform that educates. So you kind of, what you guys are offering is that educational gateway into understanding, the value of investing over time, the compounding of your investments. And you split that across multiple different portfolios.
Correct, exactly. And the reality is that when we talk about education, it's typically reserved for topics that are complex, and you need to break it down, and it's modular, and you expect when people I guess jump on the investing learning how to invest, a lot of people unfortunately get lost because it's actually too easy. Like it's very the concepts are so simple, and if you apply these concepts, they're so boring that people will start to have their own versions of them, and get lost along the way. So I'll give you an example. You know, when I was working at Caisse de Dépôt in Canada, so it's a $300 billion fund. Out of that 300 billion, 80 billion around was there probably still is in passive investing, which means you track the market and you just make sure that the investments you are making track the performance of certain markets such as the US, emerging markets, etc. The problem with that job is that you literally track the market. It's a 9 to 5. You're probably done by 3, and I hope my boss doesn't, my ex-boss doesn't see it. But it's super automated. Versus on the other hand, you had the active investors constantly trying to beat the market.
Yeah.
But if you compare and you see the annual reports, the passive investors will most of the time, and most of the time isn't 60, 70, a lot of the time it's 80, 90%, 100% of the time are beating active managers. So what this is telling you is that by simply investing and waiting and staying the course, you're outperforming the professionals that are spending their days analyzing companies and trying to come up with strategies to outperform. So let's tie it back to education, which means, I want to learn how to invest. I'm like, okay, I should diversify, I should start now, and I should stay the course.
Yeah.
Okay, but now what? This is the beginning, and then you realize you're actually done. That was it. Just keep depositing money. So this is where this knowledge gap is a bit tricky, because certain people will want to stock pick, will want to sell and buy at different times, and unfortunately that leads to what we call the behavior gap, and where on average individual investors
high, sell low.
Correct, exactly. So you won't perform as well as had you not done nothing.
I mean, that's a good kind of time to come in now from a passive investment perspective. Now, given everything that's going on in the market, volatility, obviously, I'm sure you've got a big, quite a positive view on volatility and how that impacts the market. But given the current market situations now, is passive investing a good route for people to kind of take, given the market volatility and given the kind of the central bank's role in reinflating, should we say, the market today, or attempting to?
I'd say more than ever. Usually when we talk about passive investing, we look at we go back all the way to 1929's crisis. We like to chop off data across decades of investing to show that these lessons are true. Let's look back at the last 2 months as an example. If you're following the principle of passive investing, again, which is to just stay the course, invest regularly, around the second week of March, you saw a -9% drop in one day. The day after, it bounced back by 9%. So, and now lately markets have been going up. While if you follow the news and the economy, there hasn't been that much change. So you're like, why is the stock market going? So once again, you're reminded of the stock market's volatility and how it's decoupled sometimes from the economy. And instead of trying to predict and play around with it by just hanging on until this is all over, you would be much better off than trying to sell and buy and most likely get hurt along the way.
Most of kind of the market kind of forecast is, sure, okay, things are okay. There are some artificial forces that are keeping things kind of optimistic, and there's some pumping of cash by governments kind of everywhere. And there's an overarching narrative that everyone's trying to play, that everyone's pretending like everything's fine. But generally speaking, I think the consensus is that everything is fine until it's not fine, and that day is going to come. How big the impact is, how damaging it's going to be to kind of the markets, etc. No one really knows. But if you're a guy like me who like Steve said, and like Mark, I'm not an investor. I almost invested not too long ago, but for some reason I got cold feet. Is it now a time to enter the market knowing that 6 months later the whole thing might crash and burn, or do I just wait and ride it out? I mean, maybe a very naive question, but I think a lot of people are in the same position.
To the other group that is already invested is very jealous that you have liquidity right now, assuming that you have your 4 to 6 month emergency fund, where this is the amount of liquidity in case you need to tap into it. But otherwise, it's a great time to get into the market, because think about all the other aspects of your life where you might see a lot of discounts from retailers, from, again, and we won't name drop here. But the same thing applies for stocks.
Market. Yeah.
And to quote Warren Buffett, he always says, whether it's my stocks, I like to buy them on the cheap. So, and this is where we're going to touch a lot on behavior, the behavior gap, because when it comes to money, and we see, I'm not saying that it's not easy to see money going down, or the S&P or some sort of index in the red, but as an investor, you should, and you haven't started it, you should start as soon as possible, because in any way, your outlook when it comes to investing is you should have a medium to long-term outlook. Why would you invest? If I tell you you're going to invest because you're going to have on average a 7% return, that's cool. That sounds good. Maybe it sounds a bit low. But if I tell you it's the difference between you having $1 million at the age of 50 versus at the age of 60, then you're going to be interested to be like, wow, okay, that's a massive difference. And I can have all that time back with my family. I can realize I can have the plan that I want to make. So the first thing is, in terms of rules of investing, the first one we start with is start as soon as possible, because what matters is the time in the market, not timing it. The difference between your return now versus a month versus 2 months, even the end of the year, sitting in cash is much more dangerous than being invested. And in fact, if you look at studies on who performed, they compare people that have gotten at the perfect time to people that invested systematically, to people that were so unlucky and they invested at the worst possible time, and people that were in cash. The people that were in cash were by far the worst performers, because their money wasn't working for them. So it's similar to what you were saying, where you see people that, unfortunately, richer people that have made wealth have realized this trick, that money makes money, and by investing as fast as possible to make it longer term.
So I have a couple of questions on that, and I know Steve wants to jump on it, but sorry, I'm still going to steer. I'm going to stay on the naive question side for a second. So first question, proportionally, how much of your money, take the 4 to 6 months emergency cash funds aside, how much of your money should you invest in the market, right? So let's say you kind of dice up your cash and you say, okay, how much should go to property, how much should go to life insurance, how much should go to investing in the stock market, how much should go towards specific things. Do you have recommendations, and what do you see as the right kind of mix?
Yeah, I would say you have the 50-30-20 rule that's quite popular that we like to use, where 50% is these expenses that you just have to do, 30% is more of your leisure, and 20% is what you should be investing. And it's a very simple framework. I love it because it's super simple. And that 20%, I'm not thinking, is this in my saving account or is this in my investment account? Just clear out your 4 to 6 month emergency fund and get invested and invest the rest. Have a long-term view. So, however, now the current times might tweak this framework a bit, in the sense that if I'm in an industry that's extremely impacted by this, and I don't want to risk touching my investments if I lose my job, if I have a salary cut, then how do I react? I simply extend and build up a bigger cushion. Now you can extend it to a year, so that within that year you figure out your plan to either reinvent yourself, but don't hoard cash for more than, I would say, even in this current environment, try not to hoard cash more than you should, because there's a big opportunity cost of that cash, where, Stephen, you mentioned inflation, and not growing that money.
Okay. Okay, and my last question before Steve takes over. Another last naive question. So you said that timing isn't a big thing. It's just the earlier you get in, the better generally, and all the data proves that's the circumstances. But I guess my last question is, you know, the circumstances that we're living are kind of unique in some sense, right? In terms of the unemployment rates are going to hit like I think crazy. Unfortunately, crazy numbers. We're already starting to see it in Canada, for example, where you and me went to college. We're seeing it in the U.S., and to be honest, we're seeing it right here at home, right? So, you know, it is inevitable that at some point there will be a huge dip or huge crash, etc. Now, while I do appreciate, you know, the earlier the better, and you know, it compounds and all that stuff, but do you think, and I think a lot of people are waiting for this. I mean, a lot of us naive, never invested people are saying, well, I'm just going to wait till I can get it on the cheap, like Warren Buffett always says, you know, who you put it. So I'm going to wait to see it like really go down. I want to see that cliff one more time that passes the last cliff from 2 weeks ago. And then, you know what, I'll call Mark and I'll tell him I'm ready, you know?
Yeah.
So I mean, that's, I mean, stupid as it might sound, that's really where I stand, right? And what do you think about that? Sorry, I just want to get your advice personally. Yeah.
This is now financial planning for Chris, right?
For me. Yeah, go ahead.
No, we went from. I love this example because we see it so many times, and it's the two most common use cases. The first one is, I'm so afraid to invest in that moment. But then we talk, and it's like, okay, I'm ready to invest. I love this. I can achieve my goals faster. But now we see the opposite spectrum. We're like, wait a minute. I'm gonna outsmart everyone. I'm gonna predict when it's the
lowest. The lowest of the low.
I'm gonna get in there, and I'm gonna sell when it's high. So the simple truth is, if that was the case, a lot of people would be doing that. A lot of professionals would be doing that. But unfortunately, no one has a crystal ball that can predict when it's going to be low. So to give you an idea about this effect, typically there's a financial crash every 5 years. If you look at sort of decades of investing, what happened was that so the last one was, you know, the 2008, 2009 financial crisis. But before the coronavirus, at the 5-year mark, so in 2015 or 2014 rather, a lot of people were starting to get excited. Like, man, we're due for another financial crash. It's coming. I'm going to wait. So imagine, in the last 5 years, it's been an amazing time to invest, and you would have been waiting for that dip and that correction. So the same thing happened, and we're seeing this unfortunately now because markets have recovered, and a lot of people that missed the first boat are like, oh, I'm going to wait for it to recover. But if you look at the data there's a study I really like between 1970 to around 2017. And it shows you that if you miss the 1 month of recovery, so that if you miss that 1 month where markets recover, you end up slashing your return by 2 or 3. So, and I could show you sort of this slide. Sorry, if you don't mind, I'd really like to show.
Yeah, no, go for it.
Do it.
Go for it.
Yeah.
But yeah, there's
bonus
one
feature for the YouTube piece.
Yeah, so here, if you could see, we always say the early bird gets the return. But in this study from 1970 to 2017, where you invested in the US stock market, we compare someone that stayed fully invested throughout, someone that moved into cash for 1 month, someone that moved into cash for 3 months, and someone that moved to cash for 6 months. So these are like 4 different people, where one is just staying invested, and the other ones are trying to get in and out for it during time. And you see that 3 years later, this person would have made 83%, while the others would have made as low as 42%. So the message here is, again, it would have been awesome if we can predict. It would have been awesome if we can predict the peak
bottom
and the low.
Yeah.
But it's just simply not possible. And
yeah, and I totally agree with you, and I see it, and I agree with you with the principle. I think the one kind of I'll hammer on this just because, and then I'll leave it to more intelligent conversation about investing. But
because I'm a big bear, so I'm going to go against the opposite of what we're saying right
yeah,
now.
yeah, and my point is just that everyone is still going to argue that irrespective of what you saw in in the last 10 years, 30 years, 40 years, that what we're living today is a unique moment, right?
Yeah, I love that one. I love that one because
no, I know you're gonna put me back in my place, and that's fine, and I'll let you do that. But I think bottom line, what I'm saying is, for the naive ones like us who until this point have seen people make fortunes, and have witnessed a super bear market, and have just watched the highest highs completely get blown out of the water, have seen $1 trillion market caps, and feel like, oh my god, now we should do it, now we should do it, now we should do it. All of a sudden, in the last 2 months or month, all that's reversed, right? So we've lived 5 years, like you said, of you just see that mountain get higher and higher and higher, like, oh, I missed it, oh, I should go, oh no, I should go, oh no, I missed it. And then now it's like it's finally reversed, and now you're looking at stocks. So you have a guy like me starting to look at stocks, creating a Robinhood account, and then creating a this account, and creating another account.
And that's like when you're cabbies, basically, when you get in a black cab in London and the cabbie's talking about the stock market, that's not the time to be in the stock market. Definitely not the time to be in the stock market.
Exactly. and then just to make my point, and I'm not going against what you're saying, Mark. And then you look at stocks, right? So you look at you look at your Apples, you look at your stuff, and oh my god, they dipped like crazy. But then you do show me the 5-year performance, show me the 10-year, and they didn't even dip to like, this is only the lowest in the last 6 months. Like in early 2019, they were like, and if the market's going to crash, it's going to kill 2019 numbers. It's going to go down to like 2015 numbers, and then it's just stupid. But that's how I see the world right now, and that's my hesitation. It's maybe if I should just wait 3 months or 4 months or 5 months or 6 months, and I looking at your slide already puts me in my place, like missing it by a month. And by the way, I mean, I think the answer is you're obviously not going to put your full kind of investment from day one. So you're going to dip your toes in, you're going to get comfortable with it. Do you put, your full 50% or what was it, 20%? Do you put your full 20% on day one, or do you kind of, stagger it?
Dollar cost averaging is probably a sensible way.
Yeah, you're pretending to be a beginner, Chris, but it's a lot of great stuff. So let's break it down. I would say that last part, let's leave till the end. Should I invest right away versus dollar cost average, which is the term as Stephen. The first part was, are we living in this very different, uncertain time? And I think in a lot of aspects of our lives, yes. Like look at us, on a Zoom call, or the way we're living is very different. But the stock market has seen so much more than that. Like there's never been a certain time in investing. And I always like to say, to show another graph that I'm going to skip you and just talk through it for now, of the stock market since the 1929 crash until today. The stock market has survived the World War II, the Cold War. Like it has to imagine now what we're living now, and imagine the World War II, and the stock market always recovering from every single event. It's just the way we've built our economies, the way if you look at all the trends, and we're only becoming more better and more efficient with AI and technologies. So what I'm trying to say is we've never lived in a certain time. So the market trends upward despite
at a macro level, if you're patient and you're not gonna withdraw and pull out your money within a couple of years, at a macro level, it doesn't matter. The trend is
exactly, because you only lose when you sell. That's super important to understand, because if you're just watching your investments and the negatives, and you're not acting on it, you're not locking in your loss. So
you don't really have a loss. It's not a loss.
Correct. So a lot of the time it's a buying opportunity, and a lot of the time we see people saying, hey, I want to invest for 5-10 years, but then when they see volatility, this is where they might want to change the plan. But if you stick to that plan, you'll be more than fine.